Another positive week in the market last week, guys. This bull market does not feel like it's ever going to end, does it? All these stocks keep going up. The market keeps going up. Crypto keeps skyrocketing, hit $103,000. We did a video on our main channel just this weekend. We posted it, and it was very controversial. Just to let you guys know some stats behind it, on average, our channel gets 96% of the likes to dislikes percentage. So that means if you have 100 people who vote on the video, 96% will put a like, 4% a dislike. On this crypto video, on this video about Bitcoin being a scam, it was 65% like, 35% dislike. And guys, I'm not here to sit there and apologize. Somebody on Twitter said to me, well, Paul, I think you're just being contrarian. I go, listen, it's contrarian viewpoint to say that BlackBerry is going to overtake iPhone. I don't believe that. That would be the contrarian view. But these are what's going on in this bull market. I've said that I think Bitcoin and Tesla are going to be the poster children of this bull market. Even NVIDIA, I think, has way more merit than these other two things. Why? Because NVIDIA keeps generating more and more profit. Now, guys, as you know, and if you're new to this channel, I like to look at the stock market to GDP ratio and the 10-year cyclically adjusted PE ratio. Because what I'm trying to do is I'm trying to teach a process. We're trying to be principle-driven investors. What I mean by that is we try to pick the principles that make sense to us. And guys, what makes sense to you is going to be different than what makes sense to me. But the principles I have can be applied to any sort of investment you do. With that goal in mind, I like to look at where valuations stand at any given time, not as a way of getting in and out of the market, but as a way of understanding where we are in a cycle. This bull market's been riding since March of 2009, essentially a secular bull market, and it's taken us to almost valuation levels that we haven't seen since the 2000 bubble. Guys, this is the stock market to GDP ratio, which Warren Buffett considers to be the most reliable metric at any given time. We are currently at 122% overvalued. 122% overvalued. As a comparison to 2000, look back in 2000. The highest we got, 53% overvalued. 53%. We're well over double the overvaluation metrics. Now, it's not as bad on the 10-year cyclically adjusted PE ratio. What that does, it takes the last 10 years of profit in the S&P, brings it to today, and says, what's the PE if you did all that? Well, we're currently at 38.88, which is 126% overvalued. The high was, I believe, 44 back in the year 2000. So we're still below that, but we're marching our way up. Could it hit there? I have no idea. I have no idea when stocks are going to turn around, if they're going to turn around. But in principle-driven investing, what matters is sticking to the principles that matter to us. Every investment is the present value of all future cash flow. When we buy a stock, we're buying a piece of a business. And we look for assets that have some sort of intrinsic value. What I mean by that is I want to buy assets where if the market for that asset went away and I couldn't sell it for 10 years, I'd be okay owning it because it's going to give me some sort of distribution along the way. You might sit there and say, well, I don't get that with stocks. Yeah, but you own a company that's increasing its cash flow and building up its balance sheet. And it can still pay you a dividend if the market to buy or sell that stock goes away. Same with a piece of real estate that you rent out. These are the things that matter to us. This is why I'm against crypto. This is why I also don't own gold. Because if I own gold, even though I can probably use it to go trade in and buy, if that market went away to sell it, it's not making me any money. But the gold miners who take gold and make it into something else, they can make money off it. That's why I own some gold miners and the ETFs attached to them. This is all part of this principle-driven investing that I've really come to embrace as a way of thinking about the world. Now, this week there's a pretty busy week on earnings, and I went on Twitter, good old Twitter, which I'm very active on. So follow me if you'd like to, at EMPaulG. I asked a lot of great companies reporting earnings this week. Which one do you think will have the best performance after earnings? I put Oracle, AutoZone, Adobe, and Costco. Guys, I put Costco last because I thought it was going to win. And I wanted to see that, and it did. And I think Costco wins because everybody loves Costco because Munger and Buffett love Costco, more so Munger. Guys, AutoZone is a under-the-radar great company. Great capital allocation, great growth, great free cash flow. Not great growth, but free cash flow, it's great. But everybody loves Costco because of Munger talking about it till he's blue in the face. Literally blue in the face because he has passed away about a year ago. So, too soon? Too soon? No, not too soon. Nick, I got a chuckle out of Nick for that one, so I'm happy about that. Guys, we don't know what's going to happen, though. These guys could all beat on revenue and profit, and stocks could fall. These companies could all miss, and stocks would go up. It's so random sometimes. We don't know where we are at any given moment in this euphoric market. Now, part of principle-driven investing is all about understanding what kind of investor you are. If you're an investor who looks at it and says, hey, listen, I'm here for the long haul and I want to buy good companies at great prices, then that's for you. And you can add some extra dynamics to that by thinking about things a little bit differently. I don't try to get complicated with my investing, but because of that, I'm expecting to buy bigger companies, which are going to have less likelihood of being very cheap. And I'm okay with that because I want companies that are going to be around for a very long period of time. But guess what? One of our research analysts, Dalton, who works on the channel, who he found us on YouTube and started joined our community and said to me, hey, Paul, I want to work for you. Either way, Dalton crushes in investing. But guess what? We use the exact same principles to buy very different companies. I want to buy $20+ billion companies. He wants to buy $200 million companies. He is going to make more return than I am just due to size. And I'm okay with that because I also don't want to live and die every single day looking at my investments and seeing how they might have pivoted here or there. I want to buy companies that I think are going to be around for a very long period of time, no matter what happens. Now, am I going to be right on all this? No, but this is what I realized for myself. And what I want to preach to you is part of the principle-driven investing is, what are the principles you want to live by? Do you want to live by Dalton's method? I'm okay making less, but also being able to sleep better at night and not have to worry about what my investments are doing every second of the day. Dalton loves research. He doesn't mind doing that. Two different worlds, but use the same principle-driven investing styles and metrics to do it. It certainly seems and feels like this market's not going to go down. I feel it. I look at it going, man, is this market ever going to go down? I have felt that in the past. I have felt that many times before, and guess what ends up happening? It always ends up going down at some point. How much? I have no idea. When? I have no idea, nor do I care. I've been able to find over 20 stocks that I think are priced appropriately, and I've been able to build positions. I'm going to continue to build positions as those stocks fall, because guess what? You're never going to buy at the bottom. It's just pretty much impossible. But your goal should be to buy good companies at great prices, great companies at great prices. But every great price is relative to the company. A super small micro cap company needs to be much more discounted than Meta or PayPal or Alibaba. Why? Because there's not much market for it. It's much more likely to go as a business. So the great price and the great valuation for each company is different. If you made it far enough in this video, you probably realize this makes sense to you. And I appreciate that. And I want to bring you on board to sit there and understand these things and provide some feedback to us, because my investing style has changed a lot since starting this channel. And a big reason is our community of like-minded investors. I sit there, I talk to people, I get ideas from them. I sit there to understand things, but more importantly, I do use these tools. But more importantly, I use all of these tools to make better investing decisions every single day. Our stock analyzer tool is our most popular tool. And the reason it's so popular is, and I just got a message on Twitter about this. Somebody said, man, your stock analyzer tool is great. Why? It allows you to make assumptions about the future on any company in our system. Make your assumptions low, middle, and high for revenue growth, profit margin, multiples, and your desired return. And it'll tell you, hey, based on these assumptions, this is the appropriate price to pay for this company. Let me pull one up right here just to show you. So I pull up Lululemon. I made my assumptions. This is telling me, hey, Paul, based on your assumptions, it might be a little rich. But everyone's assumptions are different. But the point is, if you have a better understanding of Lululemon than I do, you're probably more reliable on this than I am. This is a busy week overall. Let's see if there's anything else in here. I don't even know some of these companies. Oh, Ollie's. So Ollie's the discount store. Let's see what they report. Academy Sports Outdoors. All right, so this is where we stand here on the earnings this week. I don't look at earnings and think, I've got to make decisions based on these. But I want to look at it and see, what are these companies reporting to get me understand where we are maybe economically. I'm not going to have you make decisions based on that. I don't make decisions based on that anymore. But what I'm doing is, so I don't surprise myself, just like the stock market GDP ratio and the 10-year cyclically adjusted PE ratio, what it's meant to say is like, listen, be ready for a bumpy road ahead. The last 5 or 10 years are probably not going to be replicated for the next 5 or 10 years. That's okay. because if you dollar cost average into low cost ETFs, you can still do well. You should root for the companies that you own to report poorly, because fundamentally they're probably still solid companies and you should want to buy more. So guys, if you're interested in being part of a community of like-minded investors to make better decisions and to be on this road and not be lonely, go to everythingmoney.com. We have a sign-up page. There are a limited number of spots every day, $7 for 7 days. Make the best investment you're going to make, and that's backing yourself. $1 per day can help change the way in which you view money. Thank you very much for your time.